Demystifying ETFs begins with stripping away the false complexity that surrounds them, because exchange-traded funds are not exotic financial inventions. They are tools, and like every tool in markets, they can either protect beginners or quietly amplify mistakes depending on how they're used. I wish someone had explained ETFs to me early, not as smart products or lazy investing shortcuts, but as structural instruments that solve very specific problems in portfolio construction, risk management, and behavior. Once I understood that ETFs stopped being confusing and started becoming one of the most powerful building blocks in my investing life. At the simplest level, an ETF is a basket. Instead of buying one company, you buy a collection of companies' assets or exposures bundled into a single tradable instrument. That basket trades like a stock intraday liquid transparent, but behaves like a portfolio underneath. This combination is why ETFs matter so much, especially for beginners. They give you instant diversification without forcing you to make dozens of individual decisions you're not yet equipped to make calmly or consistently. Early in my career, I underestimated how valuable that was. I wanted to pick winners. ETFs quietly taught me how to survive. What most beginners don't realize is that ETFs were not designed to make markets more exciting. They were designed to make them more efficient. Before, ETFs diversification required mutual funds with high fees, slow settlement, and limited flexibility. ETFs changed that by allowing investors to access broad market sectors, themes, and even strategies with a single click. That accessibility is a gift, but it also creates a trap. Because ETFs are easy to trade, people treat them like toys instead of structural tools. The problem is not the ETF, it's the behavior around it. There are several major categories of ETFs, and understanding these categories matters far more than memorizing ticker symbols. Broad market ETFs, like those tracking the S&P 500 or total market indices, exist to give you exposure to economic growth over time. They are not designed to be exciting, week to week. They are designed to compound quietly. Sector ETFs focus on specific industries, technology, healthcare, energy, and they allow you to express views without betting everything on one company. Bond ETFs provide income and stability, though they behave very differently than stocks, and must be understood on their own terms. Commodity and currency ETFs introduce macro exposure, often with higher volatility and complexity. And then there are leveraged and inverse ETFs, which I'll say plainly should not be touched by beginners at all, no matter how tempting the upside looks. One of the biggest misconceptions about ETFs is that they are safe by default. Diversification reduces single company risk, but it does not eliminate market risk. A broad equity ETF will still decline in a bear market. A sector ETF can collapse if that sector falls out of favor. ETFs do not remove risk, they redistribute it. The advantage is that this redistribution is visible and manageable. You can see what you own. You can see how concentrated you are. You can choose how much exposure you want without pretending you can predict individual outcomes perfectly. Another critical concept is that ETFs are not just investments, they are allocations. When you buy an ETF, you are making a decision about where your capital is allowed to work. Broad ETFs allocate to growth. Bond ETFs allocate to stability or income. Sector ETFs allocate to thematic risk. This framing changed how I used them. Instead of asking, will this ETF go up, I started asking, what role does this ETF play in my portfolio? That shift alone prevented countless emotional decisions because it anchored each ETF to a purpose rather than a price. ETFs are also powerful behavioral tools. For beginners especially, they reduce the emotional attachment that often forms around individual stocks. It is easier to stay disciplined with a diversified basket than with a single company whose story you may fall in love with. I've watched beginners hold collapsing stocks far too long because they believed in the narrative, while ETFs forced them to think more objectively. You don't argue with an index. You either want that exposure or you don't. That emotional distance is not weakness, it is protection. Liquidity and transparency are another underrated advantage. Most large ETFs trade with tight spreads and publish their holdings daily. You are rarely guessing what you own. This matters when markets are stressed. During crises, I trusted my ETF exposures far more than complex products, whose risks were hidden behind legal language. ETFs are not immune to volatility, but they are honest about it. And honesty is invaluable in markets. However, ETFs can be misused badly. Chasing thematic ETFs after they've already exploded in popularity is one of the most common beginner mistakes. Just because an ETF exists for AI, clean energy, or crypto does not mean it offers a good entry at all times. ETFs package trends and trends attract crowds. Buying ETFs emotionally is no safer than buying individual stocks emotionally. The structure does not save you from poor timing or oversized exposure. Costs also matter, even though ETFs are generally cheap. Expense ratios compound just like returns. For long-term holdings, lower costs matter more than clever strategies. Beginners should default to simplicity here. Broad, low-cost ETFs held patiently outperform most complicated portfolios assembled in excitement and abandoned in fear. I learned this lesson slowly, but it became obvious over time. What ETFs ultimately taught me was humility. They reminded me that I don't need to be right about everything to do well. I just need to stay aligned with growth-managed risk and avoid catastrophic mistakes. ETFs are not shortcuts to wealth. They are shock absorbers for learning. Used correctly, they allow you to participate, while you build skill, confidence, and discipline. And this is where we need to continue next, because understanding what ETFs are is only the first step. The real value comes from knowing how to use them intentionally, how to choose the right type of ETF for your goals, how to size them within a portfolio, how often to rebalance, and how to avoid the behavioral traps that turn simple tools into sources of confusion and regret. And that transition from definition into application is exactly where we go next, as we move from explaining ETFs conceptually into showing how a beginner can build a simple, durable ETF-based portfolio that matches their time horizon risk tolerance and emotional capacity, rather than chasing performance or headlines. And that continuation is where we pick up next, as this sentence carries forward into practical guidance on using ETFs wisely as foundational instruments, rather than speculative bets, and learning how to let them work quietly for you, while you focus on building the discipline that matters far more than the ticker symbols themselves. And that is where we continue next, by turning ETFs from abstract products into a simple portfolio framework that you can actually live with through good markets and bad ones, because the power of ETFs is not in their variety. It is in how quietly they allow discipline to compound when everything else is noisy. When I help beginners use ETFs correctly, I start with one principle that sounds almost too conservative to be useful. Every ETF you hold must have a clear job, and if you cannot explain that job in one sentence, it does not belong in your portfolio. The first job is core growth, and this is where broad market ETFs earn their place. An ETF tracking a total market or a major index exists to capture long-term economic growth without requiring you to constantly make decisions. This core should be boring. Boring is the goal. It is the anchor that keeps you invested when headlines are frightening and friends are panicking. For most beginners, this core makes up the majority of the portfolio, not because it guarantees profits, but because it reduces the chance that one mistake or one emotional reaction derails everything. The second job is tilt, and this is where sector or thematic ETFs can be used carefully. A tilt is not a bet, it is a preference. You are saying you want slightly more exposure to a certain area, technology, healthcare, dividends, small caps, because it fits your beliefs or your time horizon. The key is size. Tilts should be meaningful enough to matter, but small enough that being wrong does not dominate your emotional experience. This is where many beginners go wrong, turning tilts into concentrated bets because excitement feels like conviction. Discipline here means restraint, not denial. The third job is stability, often filled by bond or income-focused ETFs. These do not exist to excite you, they exist to reduce volatility and give you psychological breathing room. In strong bull markets, they will feel like dead weight. In drawdowns, they will feel like relief. Beginners often underestimate how valuable that relief is until they don't have it. A portfolio that allows you to stay invested calmly will outperform a more aggressive one that you abandon at the wrong time. Once these roles are defined, sizing becomes straightforward. You are not allocating based on which ETF you think will perform best next month. You are allocating based on how much volatility you can tolerate without changing your behavior. This is a critical distinction. A portfolio that looks good on paper but keeps you awake at night is a bad portfolio, regardless of its expected return. ETFs make this calibration easier because they let you adjust exposure in clean, transparent increments. Rebalancing is the maintenance that keeps this structure intact. Over time, winners grow and losers shrink. Without rebalancing, your portfolio slowly drifts away from its original risk profile, often becoming more aggressive without you realizing it. Rebalancing does not need to be frequent. Once or twice a year is often enough for beginners. The act itself is emotionally uncomfortable, selling what is done well and adding to what has lagged. But that discomfort is exactly why it works. It enforces discipline mechanically instead of asking you to feel brave. One of the most important rules I learned with ETFs is to avoid constant tinkering. ETFs are designed for holding, not for entertainment. If you find yourself wanting to trade them frequently, that is a signal about your psychology, not about the ETF. Beginners who succeed treat ETFs like infrastructure, not speculation. They review periodically, adjust deliberately, and otherwise leave them alone. The market rewards patience here far more reliably than cleverness. It is also essential to set expectations correctly. ETFs will have drawdowns. Broad market ETFs can lose 30 to 50% in severe bear markets. Sector ETFs can lose more. Knowing this in advance changes how you react when it happens. Drawdowns are not proof that ETFs failed. They are proof that markets are doing what markets have always done. The advantage of ETFs is not that they avoid pain, but that they make pain survivable and understandable. As your experience grows, you may add complexity factor ETFs, international exposure, income strategies, but that evolution should be slow and earned. Each addition should solve a specific problem you have observed repeatedly, not satisfy curiosity or fear of missing out. When portfolios become crowded with overlapping ETFs, clarity disappears and discipline follows. Fewer tools used well outperform crowded toolkits almost every time. What ETFs ultimately offer beginners is time. Time to learn. Time to build emotional resilience. Time to observe markets without being forced to predict every move. That time is invaluable. Most people waste it by chasing performance. The ones who succeed protect it by staying simple. And that is the real demystification. ETFs are not about beating the market. They are about staying with the market long enough for compounding to work. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue building a calm, durable approach to investing. And leave a comment sharing which ETF role you find hardest to stick, with growth, stability, or restraint. Because recognizing where discipline slips is the first step toward making these tools work for you instead of against you over the long run.